Hello friends, welcome to this video on Gap Advisors channel. Myself CA Manish C. Iyer. This video is on amendments to Ind AS 12 which have been notified by MCA on 31 March 2023. The amendments are effective for annual reporting periods beginning on or after 1 April 2023. The amendments seek to reduce the scope of initial recognition exemption, that is, recognition of deferred tax liabilities and deferred tax assets are required if equal amounts of assets and liabilities are recognized on initial recognition. You would be glad to know that we had already, Gap Advisors had already responded to such an issue. The issue ID is 4053. You can search this issue ID in issue repository on gapadvisors.com, or you can search, you can first select the framework as Ind AS and then Ind AS 12 as a standard and type the para number 22A and click search, which will take you directly to this issue on this recognition of deferred tax asset and deferred tax liability in case of lease liability and a right of use asset. Before understanding the amendment to any standard, it is very important that we understand the need for the amendment. So, the amendments to the initial recognition exemption arose from the question as to whether a company should recognize deferred tax asset and deferred tax liability in case of initial recognition of lease liability and right of use asset, because the deferred tax liability and deferred tax asset neither arises from business combination nor the transaction affects accounting profit nor taxable profit on initial recognition. The amendments also applies to decommissioning obligations that are added to the cost of the item of property, plant and equipment. Para 15 of Ind AS 12 requires recognition of deferred tax liability, and it also specifies the initial recognition exemption. Let us understand what Para 15 said before the amendment. A deferred tax liability shall be recognized for all taxable temporary differences except to the extent that the deferred tax liability arises from the initial recognition of goodwill or the initial recognition of an asset or a liability. Please note that it is asset or a liability in a transaction which, one, is not a business combination, and two, at the time of the transaction affects neither accounting profit nor a taxable profit or tax loss. However, for taxable temporary differences associated with investments in subsidiaries, branches and associates and interest in joint arrangements, a deferred tax liability shall be recognized in accordance with Para 39. Reading para 15, one can observe that condition B uses the word or, which we had emphasized earlier. Therefore, one may conclude that when taxable temporary differences arise on initial recognition of an asset and a liability, the initial recognition exemption should not apply. This was our interpretation in issue ID 4053, which you can search in issue repository on gapadvisors.com. However, this interpretation was not clear and diverse practices were followed. Some companies recognize both DTA and DTL on gross basis, that is deferred tax asset and deferred tax liability on gross basis. Some interpreted the initial recognition exemption giving rise on net basis, and some interpreted the exemption to apply even when the transaction resulted in the initial recognition of both asset and liability. To remove this diversity in practice, Ind AS 12 has been amended to narrow the scope of initial recognition exemption requirements such that the exemption would apply only if the initial recognition exemption does not give rise to equal amounts of taxable and deductible temporary differences. This slide shows the para 15 after the amendment. Okay, so what has been amended in para 15? So you can see that there is a third condition in sub condition B, which says at the time of the transaction does not give rise to equal taxable and deductible temporary differences. So therefore, the initial recognition exemption does not apply if the transaction gives a rise to equal amounts of taxable and deductible temporary differences on initial recognition. A similar amendment has been made to the requirements of para 24, which deals with deductible temporary differences. However, the amendments to para 15 and para 24 do not clarify whether the deferred tax liability and deferred tax asset must be recognized on gross basis or net basis. Para 22A has been inserted in Ind AS 12 to clarify whether deferred tax needs to be recognized on gross basis or net basis when equal amounts of asset and liability are recognized on initial recognition. A transaction that is not a business combination may lead to the initial recognition of an asset and a liability, and at the time of the transaction affect neither accounting profit nor taxable profit. For example, at the commencement date of a lease, a lessee typically recognizes a lease liability and the corresponding amount as part of the cost of a right of use asset. Depending on the applicable tax law, we will understand the importance of this. Depending on the applicable tax law, equal taxable and deductible temporary differences may arise on initial recognition of the asset and liability in such a transaction. The exemption provided by para 15 and 24 does not apply to such temporary differences, and an entity recognizes any resulting DTL and DTA, deferred tax liability and deferred tax asset. Therefore, para 22A requires deferred tax to be recognized on gross basis uh, and not on net basis. So let us understand the significance of the phrase depending on the applicable tax law in the previous slide. Para 5 of Ind AS 12 defines temporary differences as differences between the carrying amount of an asset or a liability in the balance sheet and its tax base. Therefore, when the transaction gives a rise to equal amounts of asset and liability it becomes important to consider whether the tax base relates to the asset or the liability, which depends on the tax law. Para 5 of Ind AS 12 defines tax base as the amount attributed for tax purposes. Usually, tax law permits tax deductions on lease payments being made, that is on cash basis. In such situation, the company must determine whether those tax deductions are attributable to the right of use asset and interest expense. That is, the deductions relate to depreciation and interest expense, or the lease liability, that is the deductions relate to interest expense and the repayment of lease liability. Before we move ahead, it is important to see the definition of tax base of an asset and tax base of a liability as given in para 7 and para 8 of Ind AS 12. So, tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of an asset. For example, the amount of depreciation. Okay, so what total amount of depreciation will be deductible for tax purposes for a particular item of PP, that is a tax base. The tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. The tax base of a liability starts with its carrying amount, and then it is reduced by the amount that will be deductible for tax purposes. So if the entire carrying amount will be deductible, the tax base will be zero. Okay, but if only part of the amount is deductible, then the tax base will not be zero. It will have some value. When the company determines that the tax deductions that it will receive for the lease relates to the right of use asset. So let us understand the tax base. When the company says that the tax deduction relates to the right of use asset, the amount deductible for tax purposes will be limited to carrying amount of right of use asset, and therefore the tax base of the ROU asset shall be equal to its carrying amount, and the amount that will be deductible for tax purposes in respect of lease liability will be nil, and therefore the tax base of the lease liability will also be equal to the carrying amount of the lease liability. Therefore, when the company determines that the deductions relate to ROU asset, no temporary differences arise on initial recognition. Let us consider the situation when the company determines that the tax deductions that it will receive for the lease relates to the lease liability and not to the right of use asset. In such a case, no amount will be deductible for tax purposes when the company recovers the carrying amount of ROU asset, resulting in tax base of ROU being zero, giving rise to taxable temporary differences equal to the carrying amount of the ROU asset, and all amount of lease liability will be deductible for tax purposes, resulting in tax base of the lease liability being zero, giving rise to deductible temporary differences equal to the carrying amount of the lease liability. Accordingly, deferred tax liability and deferred tax asset arise on initial recognition only if the company determines that the tax deductions it will receive for the lease relates to the lease liability. We are not experts on income tax law in India. However, in our view, under the income tax law in India, the tax base will be determined as related to liability. Therefore, a company in India shall recognize deferred tax liability and deferred tax asset. There can be case where the deferred tax liability and deferred tax asset which arise on initial recognition of an asset and liability are not equal. This arises because of the requirement of para 24 to recognize a deferred tax asset to the extent that it is probable that taxable profit will be available against which the deductible temporary difference can be utilized, whereas para 15 requires recognition of deferred tax liability for all taxable temporary differences. However, this difference does not increase the scope of initial recognition exemption, as para 15, 22A and 24 refer to equal amounts of taxable and deductible temporary differences and not to equal amounts of deferred tax liability and deferred tax asset. While considering the limitations on recognition of deferred tax asset yeah, by para 24, we should also see the effect of para 28 on para 24. Basically, para 28 says that a company, an entity can recognize a deferred tax asset to the extent of a deferred tax liability if the deferred tax asset and deferred tax liability relate to the same taxation authority and same taxable entity, and they are expected to reverse in the same period or in periods in which the loss can be carried forward or carried back. So in such cases, the company need not postpone the recognition of deferred tax asset. In such cases, the deferred tax asset and deferred tax liability will be equal. The question that arises is how to recognize the difference between unequal amounts of deferred tax liability and deferred tax asset arising on initial recognition. Any difference, any such difference is basically due to increase in asset or decrease in liability, or decrease in asset or increase in liability. Now, other than relating to contributions from equity participants or distributions to equity participants. Therefore, such a difference is an income or expense as defined in the conceptual framework for financial reporting issued by the Institute of Chartered Accountants of India, which is recognized in profit or loss. Usually in lease agreements, a lessee is required to make lease payments in advance and may also incur initial direct costs. Ind AS 116 requires such payments to be added to the cost of a right of use asset. Because of this, there could be unequal amounts of taxable and deductible temporary differences. In such a case, one needs to consider whether those lease payments which have been paid in advance and initial direct costs affect taxable profit or not. If those payments affect taxable profit, then the company shall recognize the difference between deferred tax liability and deferred tax asset in such a case in profit or loss. However, where the lease payments and initial direct costs do not affect taxable profit, the initial recognition exemption will apply to those lease payments. The company shall not, in that case, the company shall not recognize deferred tax on those lease payments till the termination of the lease. The transitional requirements are contained in three paragraphs: 98J, 98K, and 98L. Paragraph 98J requires the amendments to be recognized in accordance with para 98K and 98L for annual reporting periods beginning on or after 1 April 2023. Para 98K requires the amendments to be applied to transactions that occurred on or after 1 April 2022. Paragraph 98N requires the cumulative effect of initially applying the amendments to existing carrying amounts of right of use assets and lease liabilities to be recognized in the opening balance of retained earnings or other component of equity, such as it could be revaluation surplus where the right of use asset is subsequently measured by following revaluation model. And this has to be done in the opening balance, that is on 1st April 2022. The amendment would therefore require companies who had not accounted as per the amendments previously to restate their previous year's statement of profit and loss in its financial statements for the year ended 31 March 2024. The companies shall have to disclose this impact in the notes in the financial statements for the year ended 31 March 2023 in accordance with para 30 and 31 of Ind AS 8. I will try to explain the transitional provisions with an example. Assume a company has a right of use asset of rupees 100 crore and lease liability of rupee 90 crore on 1 April 2022. The tax rate is 25%. The company has not recognized deferred tax on leases. Such a company shall recognize deferred tax liability of rupee 25 crore and deferred tax asset of rupee 22.5 crore and recognize a difference of rupee 2.5 crore in retained earnings on 1 April 2022, where the company has revalued the right of use asset. The company shall determine the deferred tax to be recognized in revaluation surplus and retained earnings. The same applies to decommissioning obligations and corresponding amount of PP if recognized. Thank you so much for watching this video. Please subscribe to Gap Advisors channel if you have not already subscribed. Request to register on gapadvisors.com. On registration, you get 48 hours of subscription access for free to all 6 repositories. You can play task solo, the learning game on Ind AS and Indian Gap for free. So playing task solo, that is participating in task, does not require subscription. Please share this video to spread the knowledge and awareness of Ind AS. Thank you.